All right, welcome everyone to Value Investing Live. I'm pleased to welcome our guest this week, Ben Claremon. He joined Cove Street in 2011 as a research analyst and now serves as co-portfolio manager for their classic value small cap plus strategy. His previous experience includes working as an equity analyst on both the long and the short side for hedge funds Blue Ram Capital and Right Wall Capital in New York. He is also proprietor of a value investing blog titled The Inoculated Investor. He has an MBA from the UCLA Anderson School of Management and a BS in economics from the University of Pennsylvania, Pennsylvania's Wharton School. As always, for those of you out in the audience, please feel free to post your questions, comments, anything like that in the chat section during the presentation, but do keep in mind we will be holding those until we get to the Q&A at the end. And without anything further from me, I'll go ahead and hand things over to Ben and we can jump into things today.
Well, thanks for having us. I'm going to introduce my partner, Eugene, in a moment, but thanks for having us. I appreciate anybody who's tuning in and tearing their eyes away from Wall Street bets and, it's Twitter to focus on something else because it's pretty wild out there. And I think, this presentation is pretty aptly titled Adventures in Contrarian Investing, because if anything that has been caught up in the Wall Street bets mania, it is contrarian kind of securities. So we're going to be talking about one of our favorites in this presentation. Let me mention our safe harbor. Feel free to read it, but this should not be considered a recommendation to buy or sell or any security. And these are the opinions expressed by Eugene and I are our own and do not necessarily reflect Cove Street's. I'm just going to do a brief agenda, just so to give some people a framework for what we're going to talk about. Introduce Eugene and I, and then Cove Street, and then talk a little bit about Cove Street's process and philosophy. I'm going to do a very brief market commentary and then pass it off to Eugene, who is the expert on Viasat. And then I'm going to close with a little bit of kind of myth busting from what we see on Viasat. And then we're going to jump into Q&A. Graham gave the introduction to myself. Eugene and I have been working together for coming up on 10 years now. Eugene is the expert on Viasat, and as you can see in this disclosure, he actually worked there. So that gives him, it's been years, but it gives him a perspective that I think is helpful. Eugene and I both went to UCLA for business school, not at the same time, but we're both UCLA Anderson grads, and Eugene also has a background in software and engineering, and he's the better person to be the expert on Viasat than myself. And you will hear a lot more from Eugene in a few minutes. Let's talk a little bit about Cove Street. Cove Street's an LA-based investment advisor. We're 100% employee-owned. We have about 700 million under management. We're really a small cap focused firm. When I say small, it's kind of small, SMID, and micro to some extent. And we run concentrated portfolios. That's 30 to 39 stocks in small cap, and then in the portfolio that I co-manage with our founder, it's 20 to 29 stocks. So we run pretty concentrated. We take some large positions. We'll talk a little bit about position sizing in future slides. But when we swing, we swing big. We do a lot of work, and we want to understand what we own. We want to understand the people that are running it, and then and that gets to our three pillars: business, value, people. And when business, value, and people line up, we're apt to swing large and to be kind of long-term holders. Here's our information on our website, covestreetcapital.com. We are not a hedge fund, which means that we share a lot. We're pretty transparent. Lots of writings, lots of interviews, podcasts, those kind of things. You can see more interviews that Eugene and I have done in that next link. And then Eugene and I actually have presented on Viasat in the past. This is going to be a real deep dive into it. But if you're interested in learning more about Viasat, we did another presentation on it previously. So let me get to Cove Street's philosophy a little bit. Just going to run through this because I really want to focus more on the security, but I think gives people a good framework when you understand when you want to understand Viasat within the framework that Cove Street operates under. So we're classic fundamental research-driven value investing. As I mentioned before, we concentrate on our best ideas. We are long-term holders of securities. I mean, a minimum time horizon is 3 to 5 years, but ideally we would own something forever. We want to take advantage of the mathematics of compounding. Whether you're running taxable or non-taxable accounts, taking advantage of businesses that are getting more valuable every day and can compound. You just hold on to your winners and don't try to make a million investment decisions if you've got good securities in your portfolio already. And less is more. I mean, that gets to everything. That's not just like fewer stocks, but it's just, narrow the universe, focus on, in my case, focus on kind of better quality businesses. Don't put things in the too hard bin. You don't try to be hero investing in certain things. We do a lot of work. We perform a lot of due diligence. Our process is designed to be slow. It's designed to kick out a lot of things that we shouldn't own. And in the process of our due diligence, we try to do a lot of what we call non-Wall Street stuff, which is not a euphemism for insider information. What it is it's just like going to trade shows when you could do that sort of thing, finding non-Wall Street sources like industry blogs and we do a lot of work on expert networks, just to try to find things that are outside of what management tells you and what you can find in company presentations. We are not ESG investors. That is not our that hasn't been our brand. But I would say that corporate governance is a large part of our brand, which is the G. And what I say to people is there's no good E&S without good G. Everything starts with corporate governance and people. If you have good corporate governance and people and people in charge, then you're more likely to have a business that's sustainable in other ways as well. And so we focus a lot on corporate governance. We read the proxy statement very, very carefully. And then capital allocation is something that we spend a lot of time understanding. One, we want to make sure that, people have the North Star, which is that, returns on invested capital are is what you should be focused on. But it also allows us to assess management and, what kind of returns has management been able to achieve during their tenure. And so, these are kind of me specific questions, but it applies to the whole firm to some degree. It's like, is this a high return company that's getting more valuable every day? Is this a company run by honest people who understand capital allocation? And is a stock undervalued based on conservative assumptions about the future? If those three answers are yes, I think it's likely the stock could get into our portfolio and probably at an elevated position. Going to just briefly go through our investment process. Idea generation is always where it starts. We screen for both good businesses and cheap stocks. There's nothing necessarily proprietary about our screens. What we're just trying to do is we are looking for things that other people are underfollowing or underappreciating. And sometimes that kicks out really cheap stocks, and sometimes it kicks out interesting businesses as well. We also screen for behavioral anomalies and companies in transition. That means, if there's a CEO change or company mentions strategic alternatives on a conference call, or, those are the things that start to pique our interest. We look at spinoffs, just things that, Joel Greenblatt talked about in his famous book about, just little things that people may not be paying attention to. If you're on it, you might be able to get an edge. And then, Eugene and I have been in this game for a long time. Jeff, our founder, has been in the business for 30 plus years. So you have a lot of investment experience. But prior to the pandemic, we also spent a lot of time traveling to companies. We like to go visit companies. We like to see their offices. We like to tour factory floors. I think you learn a lot about a company through that. And so that's a really good way to generate an idea. And so let's say something hits our screen and said, this is interesting. The next stage is qualify. This is just basic blocking and tackling. You read the 10K, you look through the conference calls, you scrutinize a proxy statement to understand incentives, you go through company presentations, just because, you're trying to figure out what is this business. It's really, we categorize everything we own and look at into two categories, which is a Buffett stock, which is a good business trading at a reasonable price. Kind of your proverbial 85-cent dollar. These are good businesses getting more valuable every day, high returns on invested capital, have a moat, and you're not going to buy them for 40 cents on the dollar. You're going to buy them for 85 cents, and you're going to hold them to compound. And then we have some gram stocks, and that's a cheap security, more like a 50-cent dollar that provides a large margin of safety. And so it's probably a mediocre business that is just cheap for a reason. Maybe it's misunderstood, and there's an opportunity for the gap between intrinsic value and the stock price to close. And at that point, we would probably be out of the stock. And with the Buffett stock, you might be more willing to hold it when it gets to fair value, because you want to take advantage of compounding. Our deep dive, I think one of the more unique things about our process is the 2 long, 1 short process. So we team tackle all of our ideas. We have a small team of 4 analysts, and we run a concentrated portfolio. So we have the bandwidth to go deep into the individual securities. So every idea has 2 longs and 1 short. The short analyst's job is to be the devil's advocate. Basically, we have any number of aspects of our process that are meant to slow it down and to kick, basically to stop us from owning things we shouldn't own. And that's that devil's advocate's job. Valuation is something that will come up in this conversation. We triangulate intrinsic value. Intrinsic value is not this obvious thing where it rings a bell and you're like, oh, well, this stock's worth 37.52. Like, that's not how it works. And so we use DCF, discounted cash flow. We use some of the parts. We use multiple analysis. We'll use NAV for a real estate company. So we try to triangulate value. And if you have multiple things that are suggesting undervaluation, then maybe it's really interesting. And then, we're as a deep dive, we're really trying to understand the business. Does this business have pricing power? Does it have a sustainable competitive advantage? The qualitative side can take, anywhere from weeks to months to years to understand a business. And then we layer on what's kind of like a macro risk screen, which is what we call CPEST: climate, political, economic, social, and technological risks. We're not macro investors, but just be aware of the things that are kind of external to the company that could be impactful. And the last stage is our decision process, and we decide full or half position, that's 2.5% or 5% in small cap. We have a 7.5% weighting in our mid cap strategy because it's a more concentrated strategy. So, these are pretty big position sizes. We're thinking about margin of safety. We're thinking about risk adjusted upside. We're thinking about sell discipline, trying to figure out, what would need to happen for us to sell the stock. As I mentioned, the Buffetts and Grahams have different sell discipline. And we record our decisions. I think it's one of the more interesting things about our process. Like, at every decision node, we record it. What are we thinking? What do we think it's worth? What should we do? And so we can go back if we've made a mistake or if we've been successful and look at that past. I'm just going to do a minute or so on market commentary and then pass it along to Eugene. As I mentioned, we're bottom up, not macro investors, but we do pay attention to what's going on. We don't think you can ignore it. And I mean, it's hard for me. This seems so self-evident, right? Given everything that's going on with Wall Street bets, but I actually started typing this before Wall Street bets was a thing. Signs of speculative fervor and irrational exuberance everywhere in the market, whether it's SPACs, IPOs, what we're seeing with electric vehicles and Tesla, Bitcoin, and then of course, Reddit and GameStop. I mean, these are things that I've been in the game for a while. I was not investing in 99 and 2000, but feels a lot like the kind of things going on then. But I think what people miss is that the extreme valuations is not just in, whatever the snowflakes, the things that traded whatever 100 times, 40 times revenue. It's not just that. Like, the good quality Buffett, like moat-ish companies have become really expensive as well. And we've seen extensive multiple expansion in those securities. So low interest rates, I think, as you'll see in the next bullet point, are driving a lot of valuations up. It's not just speculation and things like GameStop or things that don't have any revenue or earnings. And then the small cap value has just been crushed on a relative basis compared to large cap growth. And even with small cap coming back a little bit, there's a huge gap. Interest rates, they're driving everything. There's no escaping that, the impact low interest rates are having on the stock market. We use the acronym TINA. There is no alternative to owning stocks. And I think you're seeing that to some degree as people are piling in and inflating multiples. On the flip side, low rates means nearly free credit. And, we own a lot of things in small cap that could be interesting, either for strategic or private equity buyers. One thing that I think, everyone needs to remember is that, there are some things that could be, not particularly favorable for the market, and corporate tax rates going back up is one of them. Just be aware of that. There are some policy risk factors with the new administration that maybe people are not paying close enough attention to. And despite all of this and the speculation and the fervor, we're still finding value in stocks for people overweight disruption risk. I think Viasat is a really good example of that, but there's some others in our portfolio. Eugene and I did a long presentation on Lumen, which is to some extent gotten caught up in the Wall Street bets nonsense. But, I think Lumen is another one where that's the case. The general thesis is, and go forward, is be a contrarian, but be highly selective about what you own. Find a bunch, if you're running a concentrated portfolio, you don't need that many new ideas every year. You just need a couple. And so, kind of sort through the things that maybe are really being disrupted to try to find things that you believe are misunderstood. So be a contrarian, be highly suggestive. And now I'm going to pass it to Eugene to share with you his expertise on Viasat.
Thanks, Ben. I was going to do the presentation, but then I just realized that technically, since if you aggregate Baupost and the top 5 or 6 value funds that own Viasat, only 50% of the actual shares outstanding are floatable, and I think they're at 35 or 40% of that is the short interest. So there you go, guys. You can turn it off now and just go ahead and buy the stock. But we'll if you care to do the DD as they call it, let's flip through some of these slides, and I'll try to get through them quickly because I think that Q&A usually is a better kind of avenue for people to get more information anyway. So anyway, a little bit about Viasat as our best idea. We've actually had a relationship, an investment relationship with Viasat going back to the early 2000s. Not Ben and I were a little too young for that, but our principal CIO, Jeff Bronchick, owned the company back when it was a $3 or $4 stock. So he's known the management team for going on 20 years, harassed them back then, still harasses them to the very to this day. I worked at the company. I have I definitely love the company personally. My family worked there. I know the culture really, really well. So there's a special part of my heart, and obviously, you can argue that maybe I have some blinders on. But Ben tries to keep me grounded when it comes to that stuff. But what the company really does have is unique intellectual property and assets that I don't think are replicable very easily. Elon Musk notwithstanding, Mark Dankberg actually was the initial disruptor in the satellite space when he created Viasat-1. Back then, no one had any really high throughput capacity. In fact, the term high throughput satellites didn't actually come to exist until Viasat released Viasat-1. So technically speaking, if you want to look at incumbency and disruption, Viasat doesn't actually fit the mold of a true incumbent per se. The other, really truly, comfort that we get with the name is that the defense systems, which is part of the business that I worked at when I was there, alone can be worth, we think $46 a share conservatively alone. And so I think that's where the stock is today. You're getting everything else for effectively, a return on debt, meaning as long as they can get value that equals roughly 1.7 billion in debt for everything else that they have, you're basically getting free optionality at this price. And the reason why we think the government systems is so unique is that, we'll go through it later, but they effectively have a superior position to almost any other defense contractor when it comes to the future encrypted networking that the military needs to conduct large-scale unmanned UAV and other sort of remote operations. We'll go through that later. So the business is pretty straightforward in the sense from a really high level. They have high throughput satellites that provide connectivity, whether that connectivity goes to the government via State Department planes or DoD or SOCOM, or it goes to in-flight Wi-Fi systems. I don't know if anyone's ever flown JetBlue, that's Viasat powering that system. American Airlines is now using, I think, exclusively Viasat, and Delta just announced that they have, the initial foothold of 300 new, retrofitted Boeings that are going to be flying with Viasat equipment as well. And then they have other branches like community Wi-Fi, again, we'll kind of mention that later. And then the thing that I think most people fixate on, I think unnecessarily, which is the, consumer or broadband to the home, which is where I think Starlink is going to come into play. On the, the government services, you're talking about 7, maybe even, let's say 7 years ago, the military was effectively operating on 1980s-esque systems. They still have those systems because they want to have their own dedicated network of satellites called the WGS to maintain some operational connectivity if the commercial space goes down for whatever reason. But the ability for Viasat to deliver bits is an order of 100, if not even 500 times better than what the military had before. In-flight connectivity, it's funny, back in 2000, roughly, Viasat was the first one partnering with Lufthansa to make what's called connection. So they were the first ones to, Lufthansa was the first one to provide in-flight connectivity solutions. Viasat made those terminals for them. So their kind of, pedigree within in-flight connectivity goes back many, many years. People don't even realize that, but it does. It's now come to the forefront because they've effectively displaced Gogo and Panasonic as the dominant player in domestic U.S. short-haul flights. So again, I mentioned all the airlines that have them. I think I missed United. So they've won a dominant share in a position there. You have 12 megabits per second to the seat, which doesn't sound like a lot, but hey, you're 40,000 feet in the air, flying really, really quickly. It's pretty good. They currently are on, I think, 1,380 planes, and they have another roughly 800 to 900 in backlog. And that's before, obviously, the whole global system is up and running, Viasat 3. The community Wi-Fi, so people talk about Facebook wanted to have, hey, we're going to have these satellites to connect poor people in Africa because no one's going to build out infrastructure for them, and that's a worthwhile cause. However, it's not feasible from a cost perspective because poor people in Africa can actually support your system. However, Viasat has actually proven out that within Mexico and a lot of the pueblos where they beam down to a centralized tower, those areas can actually get, fairly inexpensive connectivity. I'm not saying, they're not talking about, high-speed fiber-esque connections, but something where you can actually use a smartphone on. And they've successfully built out this network within Mexico, and they're going to do the exact same thing in Brazil. And these are 100% exactly the same things that Facebook and once upon a time Starlink talked about in terms of serving underserved communities and providing connectivity to ubiquitous connectivity to the entire world. And then lastly, direct to home consumer, again, they have about 600,000 paying subscribers. They've had those same roughly, that's count, for 2 or 3 years. And that's where Starlink is obviously going to be, a problem, not just for Viasat, but for Hughes and other providers around the world. So what do we see kind of around the corner? The Viasat 2 network was effectively a little bit better than 2.4, 2.3 times more bandwidth capacity than the initial Viasat 1. The third constellation is going to, effectively create an 8x leverage on the available bandwidth capacity for the entire system. Why is that interesting? Well, if you aggregate the capacity of all the geostationary satellites currently in existence and planned, Viasat 3 constellation is greater than that, right? So it's an impressive technological kind of lurch forward for geostationaries, and it will allow Viasat to create speeds to each individual, either consumer, government, government customer, in-flight customer, whoever, that are roughly 2 to 3 times what they are today. Again, I'm sure a lot of the shorts and most of the short pieces concentrate on the broadband side, and they point out, rightfully so, that the average consumer is pissed off that, hey, I'm paying for 12 megabits per second, but it's terrible, and maybe I can get 10, and there's a lot of complaints about that, and it's true, right? Because they have a fixed capacity up in the sky currently, and they effectively utilize most of it because they allocate certain parts of their beams to government users, in-flight users, and other folks like within the community Wi-Fi. So not 100% of Viasat's Constellation goes to the broadband subscriber, but the third generation Constellation will allow them to, again, they're not going to reach equity with what Elon Musk is talking about on Starlink, but they will provide an actual alternative to DSL. And that's important because there's still 17 roughly million users of DSL modems. The average speed across about 15 states I checked was somewhere on the order of between 22 to 29 megabits per second, which actually includes California, believe it or not. We think that we're so high tech and blah, 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 but that's only on the coast, and Riverside County and Inyo County and Humboldt. I mean, people are still remote. So there's a pretty large runway. Obviously, Starlink will, I personally believe Starlink has a great long-term growth trajectory there, but Viasat will get a fair share, and because they will improve the quality of their service, I think a lot of the people that have complained about reaching caps and running out of space, especially within the pandemic, and I think that a lot of that will abate going forward. So again, what do we see? What does that matter? What do we see that I think people completely discount to zero? We see that in effectively 3 years, when they have the full 3 satellite constellation up, and I should have mentioned that it's not just North America. The first one's going to go over North and South America and actually cover, due to the way that it's designed, it's actually going to cover the Atlantic passage plus roughly half of the deep Pacific area, which is important for U.S. maritime naval operations. The second one is going to go over EMEA, and that's going to be a truly game changer. The reason why is because, as opposed to North America, where they have Hughes as a binary competitor currently, and obviously Starlink rising, EMEA is greenfield for them. They have current defense customers in the UK. They're starting slowly to break into other European nations like Poland, and then basically a massive untapped potential of users through the European distribution channels that they got with their Eutelsat JV unwind, which now they own basically a consumer business in Europe that's kind of low key and no one talks about. And then what I think is the true magic here is that obviously, if you think about where our military needs higher end connectivity solutions, and where they currently already spend billions of dollars, and you can just look at Intelsat or Inmarsat's or Eutelsat's government line items, segments, and then they can kind of extrapolate, how big of a market that is. So EMEA goes over the Middle East and all the way into I think the Pakistan, India, kind of Kashmir border. So as you can imagine, that's going to be in a highly demanded part of the world, especially for the government systems. And that for us translates into effectively better than doubling the current run rate of EBITDA in 3 years. And the stock has absolutely none of that built in. Existing, I think, I kind of went through the things that they currently have. I think it's more interesting to talk about potential. So maritime Maritime is an interesting market because it's very difficult to break into it. There are a couple of companies that control the distribution effectively because they provide service, and it's more than just strictly connectivity. So Viasat acquired one of those companies roughly a month ago called RigNet. I will just say the following: if someone is interested, they can go and crack open RigNet's 10K, go to their cost of goods sold line, and then look at the satellite connectivity fees that they pay, which goes obviously into COGS because they are just an integrator effectively of other people's technologies. And then imagine like, well, if I also own the satellite, am I paying anyone any fees at all? And then maybe do the math on what that acquisition kind of looks like for Viasat. So I'll just leave it at that. And then they have other competitors like Speedcast out of Australia, which is I think the old L3 Harris business, Harris Caprock. So there are a couple of major players out there, and Viasat has bought their distribution. I think that's going to be an interesting longer-term growth trajectory because Speedcast relies on very antiquated KU, KA hybrid technologies that rely on the incumbents around the world as for the connection providers. And I believe Viasat will have something on the order of a 10x advantage on a cost per bit basis versus Speedcast going forward. So oil and gas is very similar. Actually RigNet's core is oil and gas, so maritime and oil and gas is somewhat interchangeable. 5G backhaul, I think a lot of satellite providers, including Starlink, have always talked about, the idea that it's actually more economic to use satellite for backhaul solutions if you want to extend 5G's network edge beyond the core, urban environments, because it's cost prohibitive to lay fiber and put up 5G towers because of the way that the frequencies work. You need to have really dense areas for 5G to do what it's supposed to do. So you can actually use, satellite services to kind of backhaul or move a lot of the data around. And I think actually Starlink has fantastic potential to do that, given if they can get their inter-satellite links correct. I think it's going to be very interesting for them. And then lastly, business services. Viasat has, a nascent business. We spoke with formers that, it could be bigger, right? And again, if you're talking about why would anyone use a terrible connection, even we in our closet right now, even though we have coax or cable wired up, we use a DSL rollover just as a cheap kind of backup solution because we need to, given the fact what we do day to day. There are a lot of businesses, especially in the outer edge of bigger cities, that have similar needs where you just need to have some backup solution, and there is a business case there. Again, it's not large, but there could be some potential. So the existing side, the consumer broadband, it's very 600,000 users in the U.S. It is what it is. Like I said, the average speed across the network is somewhere around 29 megabits per second, and that it's not fast. There are certain areas where they can get 50 to 100, and those are really expensive plans, calling $125 to $150 a month. But I think the third generation from the math that we've done will actually allow them to step up the entire average to somewhere in the 40s. And the lower end, meaning the people who currently complain about having terrible 10 to 12 megabits per second connectivity, they'll have something on the order of 25, which is equivalent to, a CenturyLink DSL modem with better uplink reliability. And if you look at AT&T stepping away from rural customers and basically saying we're not going to do any more DSL accounts in general, just squeeze and milk the rest. There's a great article in Wired talking about how they're basically not spending any money on even maintenance capex, and some existing customers are down to like 4 megabit connections, which is like barely better than what I had when I was in high school. There's a lot of runway there, and not just for Viasat, but obviously I think Starlink will be a big winner there. And then next, in-flight connectivity, I did it through fiscal 19 because obviously 20. Let's just pretend 2020 didn't happen. Obviously, there were very few, if any, planes flying around. I think last quarter they were back to somewhere around 900 or 1,000 out of their all the tails that they have that are back in service. Obviously, the loads are much lower, right? There aren't that many people flying per plane. But you can see the trajectory that they were on, where in-flight connectivity as a percentage of the satellite services revenue was increasing every single year. And that's important because all else being equal, I'd rather have a plane connected than 1,000 or 100 users connected. I don't have to deal with churn. I don't have to deal with maintenance rolling costs for all my dishes doing something and I need some help. There's no effectively no customer acquisition costs. It's straight profit, right? And so it's a great business, and it was on a great trajectory, as you can tell by the graph. I think once whatever weirdness that we're in abates and people go back to living somewhat normal lives, that's going to continue on, and they have an immense runway, right? Just once it's international. Remember, that was just a snapshot of what they had in North America. Some international, they had like Qantas, but they're kind of doing a hybrid hodgepodge network there. But once they have a global setup, now they're going to go after long haul flights, which are roughly 2.5 times as profitable per flight as like a train, New York to LA. So stay tuned. I think there's going to be a lot more announcements roughly right after the launch of the third satellite. I think a lot of people are just waiting around just to make sure that it doesn't blow up and the network starts functioning. So okay, this is a great slide. What differentiates a satellite provider? If you just look at Hughes versus Viasat versus Inmarsat, Intelsat, SES, O3B, what's the difference? If you think about connectivity is effectively a commodity, right? In all commodity markets, the lowest price per unit wins. This is no different, right? You don't care as a consumer or government entity like, oh, this is branded as Hughes or Viasat. No one cares about that. They just want connectivity. They want the most connectivity, the best connectivity for the cheapest price possible, right? That's just what it comes down to. So this graph shows you the effective transition over the past 10 years from where the DoD was to where the initial Inmarsat GX network was, to Intelsat's Epic network, to Eutelsat's KA, to the first Viasat, then Hughes Jupiter 2 Constellation, which is actually a ripoff of Viasat. Not Hughes didn't do that. It was L'Oreal that stole the technology and built the satellites for Hughes. And then you have Viasat 2, and then you have Viasat 3. And as you can tell, there's a pretty clear transition to lower and lower cost dollars per bit delivered. And that matters because if you're Viasat and you're competing against people who built, spend billions of dollars like on the Epic Constellation, and whose entire pricing model is dependent upon them getting some money back for all that cash that they spent, you can underprice them underprice them meaning offer more connectivity, right? Not the price can be the same, but then the amount of connectivity you get is 10x. And steal customers all day long, because again, going back to my point, customers don't care who you are. They care about how cheap is that, what am I getting, how cheap is it, and is it reliable? So if you hit all those things, it comes down to just dollars per bit. And out of the geostationaries, Viasat has an incredible advantage. It's not on this graph, but there's a Viasat finally publicly announced that the 4th generation, which will come after the 3rd, will be something around 6 terabytes. So that's 6x what the 3rd generation is. it's hard to put into words how futile the other geostationary players kind of futures look, in my opinion. Anyway, so let's talk about Leo. I think this is probably the most interesting thing because a lot of people have, obviously rightfully so fixated on what Elon's doing with SpaceX and Starlink. But there is a lot of hype about Leo in general. I'm not, Starlink is a portion of that, and obviously the largest portion, given that they're the only real one out there. But you have Telesat talking about it. They've raised $600 million. That's a lot of talk, but they haven't actually done anything. I think they have some subcontractors that they've already kind of pre-approved this, the makers for their ground equipment and things like that, but no cash has been deployed as far as I can tell. OneWeb, was this high flyer, raised $3 billion, and that was going to be the disruptor, right? Bankrupt. Exited bankruptcy thanks to the UK government and their forgot the Indian partner's name. TBD what that's going to look like. For the most part, OneWeb is a polar orbit, so it is really interesting because it provides connectivity on the poles. And not to get all dorky, but the geostationaries have an issue with connecting with something flying over the North Pole or South Pole, mainly because of the curvature of the Earth, and so you actually can't you can't direct a spot beam and have it hit something as it's going over the top, because it's like a line that flattens out and you can't see it anymore. But these guys have polar orbits, and that is an interesting, asset for them. Obviously, Starlink, I think, is bar none, in my opinion, going to be the only successful LEO longer term. So similar to what Iridium became back in the 90s. Go back to the 90s. There was, I think Bill Gates of Microsoft was talking about launching satellites and pumping billions of dollars, and all these other companies raised money and blah blah blah. And guess what happened? Everyone went bankrupt. Iridium was the only survivor, because it's really hard. Let's just put it that way. As a little side note, it was Elon gave a keynote at the satellite conference, and he had a great presentation, and most of it was about SpaceX and the amazing job they've done there. And I think the one comment he made about Starlink, he said, "My goal is to be the first LEO to not go bankrupt." And I think that's pretty telling. He's a very smart guy, and he's not, this isn't he's not doing this for fun. He's doing this to try to make money, but he understands the challenges he faces as well. Anyway, but just let's concentrate on Starlink, because I think that's the biggest, people immediately point oh, well, Viasat's the old tech, and they're the incumbent, and Starlink's just going to wipe the floor with them. So a couple of things. Again, I believe Starlink is going to have a constellation. Let's just start there. I think he's going to be successful, but it doesn't mean that Viasat won't be successful as well. And so let's just go through a couple things. So there's an assumption that Starlink has or will have something called ISL inter-satellite links, and basically think of it as a mesh network up in space where each satellite talks to each, the next satellite, and you can effectively hop communications from one to the next. And that's important because you technically right now, in the way that even Starlink is designed, you have to see a gateway or a ground station in order to beam back information and receive information, right? That's how the satellite is effectively created, right? And how it operates. Well, the ISL allows these satellites to not have to see the ground stations, and basically, kind of chain link the communications along a path in space, and then drop them off wherever they need to be. Okay, it's very interesting, very cool tech. Originally, they were supposed to have it in version 0.9. Didn't, because it's not that easy. speaking to a few people within the space, they basically couldn't make it work up until the end of last year. They did wind up launching 10 polar orbit satellites in January. They're the first ones in their entire 1,000 satellite constellation that have ISLs, but it looks like they're more like test beds, meaning like I think they're going to see whether or not their laboratory experiments actually work as designed in space. So that's still a question mark. And the other thing I just want to point out, there's a company out there that specifically only does ISL design and development work, and they have a contract with New York Space Systems, and this is their core, right? And a lot of smart folks that started it, that's always been their research and their focus. Well, according to them, the build of material for a laser terminal that goes onto one of the satellites is roughly $250,000, making you need 4 terminals per satellite. So each satellite, at minimum, for the laser systems to work, has to be about $1 million in cost just for the lasers currently. The reason why that's important is because Elon has always talked about the all-in cost of one of his satellites needs to be $1 million and under. And that includes the amortized cost of launching, the chassis, all electronics, ISL, and what am I missing? Battery components. So anyway, the all-in cost, and that's currently a Herculean effort. And again, I don't want to bet against them, but I don't think that's a 2-year process. That's more like 7 to 10 years out. The other thing, sorry, go back for a second. The ground stations worldwide, in order to have what they need about 100 to 130. Gateways, you need to have 4,000. The phased array antennas, their CPE costs, again, he said 100. They're nowhere near that. The breakdown that you can see it on YouTube of one of the dishes, their UFO on a stick, we had an RF engineer kind of looked at it and gave us a rough estimate of $1,200 to $1,500 for just the materials inside. And then success rates, 99.9, so I just rounded to 100, it should be 99.9%. Starlink had some issues initially, and I think they are getting better. I think their fail rate has declined to somewhere between 1% and 2%. The last, I think they had 2 fail out of 60 launched, twice in the past 3 missions. So anyway, it's getting better. I think before it was like 8 to 10%, and they're learning as they go along. So I'm pretty sure he'll be fine longer term. I just wanted to point out that it's not instantaneous, I guess. And the other thing, and just a little caveat, so they have okay to launch 4,400, but they changed the desired orbital plane and the altitude to 550 kilometers. They only have, I think, 1,584 cleared, so roughly 1,600 cleared. That's a problem because the FCC has been bombarded with petitions. Viasat is obviously causing them problems too, but it's not just them. It's OneWeb, it's Kuiper and Amazon, it's Kepler. A lot of people are yelling at the FCC saying, "Hey, you can't let them do this because there's all these other risks, whether it's their RF interference issues, the orbital debris stuff that no one talks about. There's just tons of things that they haven't truly outlined how they're going to get around everything, and so it's a lot of pushback and their ability to get the full 4,400 launched. I just want to point that out, that it's not a foregone conclusion that this can be ramped very quickly for him. I think he will get it eventually. I'm just saying that it's not, this isn't going to happen in a year or 2. So getting back full circle to where we started, which is our downside protection, right? Government systems. What do we see in government systems? We see that Viasat has traditionally been a leader in secure connectivity, encryption-based systems. I work on the KG group that Viasat has internally. That's an appliance that runs high-speed connectivity and does on-the-fly encryption and decryption stuff for DoD. They used to be a tiny player competing against guys like General Dynamics. They took most of that space from GD and L3. That's what they're known for. The core of the Link 16 network effectively now runs connectivity for our warfighters, ranging from special forces all the way to the F-35. It's truly best in class. It's not exaggerating. You can look at any of the RFPs that have come out in the past 10 years, and you can see who's won any of the connectivity solutions, whether it's Blue Force tracking or MIDS-J or the BATS terminals. I mean, it's been Viasat in the dominant pole position there. They've continuously developed new technologies. The one thing that separates them, which is why it's not as easy for Elon to beat them as was for him to beat ULA when he created SpaceX. It's not as easy because Viasat spends hundreds of millions of dollars of their own capital every single year on R&D. And that's something that defense people usually don't do because they're lazy and they like to live off the fat of the land and effectively get taxpayer subsidized dollars to do R&D work. Viasat doesn't do that. They spend their own cash. They actually have tons of development that it's not in the official DoD plan. And so Viasat looks 5 to 10 years ahead and says, this is where they're going to go. They just don't know it yet. We'll do the work and all the heavy lifting of the tech up front. And then we'll say, hey, look, we have what you need. Here it is. And so, I mentioned Link 16. What's Link 16 is it's basically, I said, MIDS-J, the KG units, the Core 24 small tactical terminals, the BATS-D handhelds used by special forces and other parts of our armed forces, and the BATS-E, which is the embedded part of embedded equivalent of BATS-D that goes into UAVs and other autonomous, connected devices, including missiles. So all of that put together, you can look at it as a network effect that Viasat has that other people in the defense world don't. Why is that important? Once they have a global satellite constellation, once they have a way more available bandwidth, it's a truism to say that the future war will be fought effectively by nerds with joysticks in bunkers somewhere flying, maybe not even, you won't need them anymore because you'll have AI, but you'll need high-end connectivity solutions. That's where the world is going in defense tech, and this is where Viasat is positioned correctly. This is a graph of the defense business of what it's done over the past 2 years. Massive CAGR for the revenue, and by the way, they grew through sequestration, so that you can't even point and say, well, that's the Trump administration's sort of ramp up in spending. EBITDA margin continues to leak upward, mainly because what they're getting is that they're not just getting their product side ramping, they're getting the service revenue going, with the service revenue being the connectivity using their own satellites. That will continue to expand, and they'll actually stop paying. Some of the service revenue is actually shared with partners because they use other folks to patchwork quilt the entire global network currently. When they don't have to do that, they'll increase the profitability. Again, they're positioned in the right vertical for defense tech, space systems, encrypted connectivity, and autonomous encrypted connectivity. That's going to be the growth irrespective of whatever administration takes over. I mean, it is what it is. I don't think the United States is going to go to a zero budget for defense. So, well-positioned, looking at valuation for these entities, I mean, it's pretty evident that Viasat has the highest margin on here. Their growth rates are much higher than most of these guys, and their backlogs are, in terms of backlogs divided by current revenue, is much higher than every single one of these. The FLIR just got taken out by, I think, 18 and a half times. we're not even going to go there. Okay, well, let's not use those crazy multiples. We said the average is 14. We're going to use 80% of that because we're value guys. And what do we get? We get that $46 a share. So the actual true value, technically speaking, for a standalone entity, you can argue closer to 60 maybe. But let's just use this sort of kind of some of the parts. So we have 46 for the government systems. That implies like roughly 3.2 billion in EV. You have the rest of the other EV at 1.3. So you're implying that the 5 billion plus that they spent on Viasat 1, 2, the one satellite for 3 that's already done, and the second one, which is the EMEA one, which is I think 80% finished, and then the work on the APAC one, which is about 25 to 30% done, inclusive of all the ground stations that they've done and the ground systems and laying their own, buying their own fiber or leasing the fiber, putting out, international connectivity, building out a sales force, all that stuff. So you're saying that the current market implies that Viasat is only going to get 26 cents back for all that investment. We just think that that's absurdly cheap, and it's an incorrect analysis that's been done by Wall Street and also a lot of hedge funds who have shorted Viasat, akin to what happened before the second one was launched. There was actually a really great short piece put out by Carisdale back then saying that, they made the exact same points, by the way, that every single short you can read on Seeking Alpha or whoever puts out, it's verbatim, copy and paste. The only other nuance is the Starlink issue. Anyway, and it was a great short, and then it wasn't a great short because in the end they completely missed what I'm going to say for the 100th time, the defense side, that completely misunderstood the company and the core and what actually drives profitability longer term. And it's going to be the exact same thing, just rinse and repeat. And unfortunately, you look stupid in the meantime, but be patient, and I think you'll get paid for it. Again, there's another way of looking at the sum of the parts. You have $46 for the government side. If you just assume that you're going to get back your capex, and they didn't invest at a ROIC that's going to be lower than their weighted average cost of capital. So that's what the capex recovery is. And then the NPV for the V3 Constellation, which I kind of do on a satellite by satellite basis, is that you get less the debt that they need to incur to get them to a break-even point in terms of their own self-funding, $126 a share. So that's another way of looking at it. We try to triangulate value, right? There's no right, especially on something like this, it's kind of difficult. But everything tends to point to a very large upside versus a limited downside because of the defense value. So that's, I think, what we see in a very long-winded nutshell.
Thanks, Eugene. I'm going to run very quickly because I know we're running out of time. I'm going to run quickly about through the myths and misperceptions because I think this is really important. And there's a lot of, I think, just misunderstanding of this company. So one, the idea that the low Earth orbit satellites will limit the U.S. broadband opportunity for Viasat. Very simply, we think the total addressable market is large enough for multiple players. This is not Google search where there's just one dominant player. There's no single winner in fixed broadband either. Verizon and Charter and Comcast, everyone competes there. Viasat 3 will have the lowest cost per bit and will be very competitive with whatever Starlink puts out there. And Starlink will not be the only winner, just like Verizon's not the only winner in fixed broadband. And there will also be new applications that will emerge that will increase the total addressable market, whether that's Internet of Things, whether that's just other things that have never been possible because there was no connectivity to those end uses. Latency is kind of the bugaboo. Everyone says, the LEOs are better because they have lower latency, and latency is really important if you're gaming. But if you're just searching the internet, latency is not it's not that important. And so it is a key factor, and we're not dismissing it, but there will be solutions through kind of a hybrid network that Viasat could potentially reduce latency. So that's the LEO threat. The other one, rural, kind of like the idea, and the short has always been the U.S. rural broadband market is not as big as people think it is, and Viasat is just tied to that. I think Eugene's gone through pretty carefully how that's not the case. Our assertion is that in 3 to 5 years, Viasat will be known as a defense company first and an in-flight connectivity company second, and rural broadband will be a small portion that we're not even going to be really talking about. Viasat has established a number of Trojan horses with the military where they're basically in position to vertically integrate, where they have the ground stations, and then all they need is the EMEA and the APAC satellites to be up so that they can connect their existing hardware to those. It's just a perfect Trojan horse that when the satellites are up, the military will be signing up for connectivity. And that will allow the US DoD and the MOD in the UK and our other partners and allies to enter into a new world of real-time connected warfare. And in addition to that, as Eugene said, when all the satellites are up, there's going to be the opportunity for, if you were flying from New York to Dubai, you will have connectivity the whole time. That does not exist today in any way, shape, or form, or at any speed that makes that would be reasonable for anybody. And Viasat would be able to enable that. We think there's a huge TAM there. And then there's the ESG factor. As Eugene said, Facebook talks about connecting the world. Viasat is already doing that. They're already building out systems, networks in Brazil and Mexico and Nigeria to connect people through community Wi-Fi. Two more quick ones. Viasat is an old tech company that's going to be, disrupted by Starlink. As Eugene said, they are the disruptor. They're the ones who are going to be disrupting Hughes and Inmarsat and the other guys based on that cost per bit. And as Eugene said, the total addressable market for DSL and for existing satellites is like 20 million users, which is just a huge number. And then lastly, Elon Musk is just so spectacular, and then he can do things that no one has ever seen. I think Eugene's talked a lot about that. There's physics and costs that still apply here, and it's going to be really expensive to compete successfully against Viasat. And we're not saying Starlink will be successful, but regulators and the reality of supply and demand are going to be, I think, barriers to his success. And but we will admit that Musk and Starlink have absolutely won the hype and PR battle to date. And with that, I think we've talked about the risks pretty substantially. But you just should remember that at any point a satellite can blow up, in air, can collide with another satellite. There's always a launch risk. There's always the LEO risk is something we've discussed, and then the defense budget is always something to think about. But we just think that all of these things are priced in, and you're not paying a whole lot for all the good things that could happen. And with that, if there's any time for Q&A, we'll switch to that.
Yeah, let's go ahead and we'll take 10 to 15 or so here and jump into some of these questions. Graham, are you seeing questions? I guess I'm not necessarily seeing any. Yeah. Just try. Oh, okay, got it. Yeah, sorry. Now I see it. So this is a great question from Frank Wang. Any concerns with Mark Dankberg stepping down from his position? What role will he be playing, and what will the effect on Viasat be, Eugene?
I would say that I think Rick Baldridge has run that business for the last 10 years anyway as COO. Mark is certainly, a visionary, on par, I think personally, with Elon in terms of the revolution that he's, kind of put forward in space tech. Him stepping to executive chairman, I don't think it changes anything. He's still going to do strategy. He's still going to be involved with a lot of the FCC and regulatory things. He's still going to be, he's still going to conferences with Rick, even though I'd rather have Rick be the, kind of like the champion for Viasat, just given that he, I think he speaks more, businessy. But I don't actually think anything's going to change. And Mark's not going anywhere. I mean, him being chairman doesn't really affect the company. It's still, Mark's company. it's still, everything sort of still kind of flows from the top down from him, and the culture obviously is still going to be intact with Rick. And just so everyone understands, Rick Baldridge, there's probably a higher likelihood that there'll be a different CEO. We think, in the next year or two. And most likely that person will be the one to take Viasat to, maybe into the next sort of phase of its growth, with Mark still being around, and Rick's probably still going to be on the board. But we don't think that Rick is going to be the CEO for the next 10 years. Let's put it that way.
We have another question here this is a good question from Larson Rice. Why has Viasat's free cash flow been so low and returns on invested capital been down over a number of years? Like what's driving that, Eugene?
Right. So it's hard to see. Well, there's no free cash flow, right? I mean, they've outspent their the growth in cash flow from operations in order to get the third generation up, and effectively the reason why you don't see returns is because tons of capex, building a massive global constellation, and setting up distribution channels across the world takes a lot of money, but you don't get to see it. And so effectively we've been waiting for 3.5 years for the moment that's going to come probably next year when the first one of the third kind of goes online, followed by about another 6 months, the second one comes up. But that's when you should start seeing the returns flowing in. It's kind of, I think Ben's always made this point. It's like, what's the return to a real estate developer before they build a huge skyscraper, right? It's going to be zero or heavily negative because they just spent hundreds of millions of dollars creating this building before they get money coming in from the leases. But once you lease the building out and start getting cash coming in, that's when you get the free cash flow. Then that's how you can judge the returns. I think there is a way to judge returns actually on the first and second ones. You just have to. It's non-trivial. I have a massive model of how I gauge whether or not they're doing what they say they've been doing. I estimate, this is my own internal estimate, that their IRR is something around 18.5% on the money that they spent on number 1 and 2. So if I extrapolate that onto the third one, which is how I get my NPVs and whatnot, that's kind of helps with the actual value of the company. And so I invite people. You can back out a lot of this stuff if you just listen to what it costs them to build one satellite, what they spent on the infrastructure, and just assume that that's what they've been doing for the third one. If you back that out of capex and then the capital deployed, and then say like 1 and 2, this is what they look like today, you can kind of gauge what they're actually getting in terms of returns. But that's a great question, and I think you should start seeing those returns kick in the next year or two.
Eugene, we have another good question here from WK. Why is Viasat's share price down so much since 2014? What's like with all you're saying and all the positives and the military business that's done so well, like why has the stock not performed better?
It's a show me stock, and again, I go back to 2017, I think, when the Kerrisdale short came out, and they took the stock down to like $58-ish, something around there. It's hard to see around the corner, right? And so most people just say like, well, I don't believe that they can do what they say they're going to do, and I don't believe that they can get the returns, and I am also afraid of the binary risk of the launch. Right. So once the second one went up in the air, the stock went up to, I think, in the mid 90s. And so, 18 to 24 months ago, it wasn't a bad return. It was a good return. And then, if you really want to look at it, 2020 happened. It's bizarre because once upon a time, people traded Viasat on broadband subscribers. And their broadband subscribers have been slightly up actually through 2020, and the ARPUs have just ballooned because the actual bandwidth desire and need for the population has just exploded. And again, going back to Ben's point about the TAM expanding, I actually think, Elon and Mark are front running what is truly a ever-growing pie of rural connectivity and demand for connectivity all around everywhere. And forget about North America, I'm saying the world in general. So anyway, 2020 happened and IFC basically went to zero. That's a really high, roughly, I estimate about 100 to 110 million of revenue lost from there. And that's 100% profit flow through. So that's why the stock was deflated. So then people stopped caring about broadband because broadband was doing fine. Now they started caring about IFC and saying, oh, IFC's, this is a COVID disaster and the stock is cratered because of it. And yet, if you look at the actual results, the results haven't cratered. And the reason because it was what we love about this company is you can't aim directly at one specific thing and hammer them, because they have 3 to 4 different business lines that enable them to get the returns that they need on the satellites. And that's another important point. It's not about broadband. It's not about military. It's not about maritime. It's not about IFC. It's about all of those things in totality. So, stock's down because, it is heavily shorted and people hate it. I think a lot of people think that this is some sort of weird if you can't go long SpaceX or long Starlink, so you short Viasat. I would argue that if it's an interesting strategy, but I would rather short Hughes and we're not a hedge fund, but Hughes and SES and Inmarsat. Actually, I don't know if they're public anymore. And Eutelsat. Those are the true incumbents, and they're the legacy players that are going to be blown away, not only by Elon, but also by Viasat 3. So that's my argument is that people are they don't understand that Viasat is going to be a player longer term. They discount that to zero, and that's why the stock's down.
Another good question from Frank Wang. It appears that Viasat has a strong relationship with the military. LEOs have less latency because they're closer. Are LEOs a threat against Viasat's moat in the military because of that low latency?
I think LEOs will be complementary. It's a great question. The DoD has put money towards examining whether or not they want to have their own LEO network. There's a couple of things that make Starlink's path in the military side a little bit more difficult. One being you need to have the right antenna systems on the ground to handle LEOs. The current generation, I don't believe, has the ability to do that. It's not a trivial exercise. That's one. Two, this comes from, I don't want to be public with who it was, but a former person at Starlink mentioned that the design of the satellite never had encryption in mind. So that's going to be a problem when they start trying to get certificates and DoD clearances done, because part of Viasat's moat is the actual encrypted part of the Link 16 network, jam resistant, radiation hardened, built specifically for wartime operations, and not as a afterthought. So I will leave it at that. But certainly, I think there is going to be a space for and need for and use for LEOs with low latency. It's actually, again, I personally root for Elon and Starlink, because I think what he's doing is it's very cool, and I think it's going to usher in some very interesting use cases that I think most people haven't even thought about. So
maybe we'll take last question from Richard Daly. Viasat has had several delays. Are they having trouble developing their new satellite systems? I think he's referring to the delays, that we've seen from Viasat 3. What are your thoughts there, Eugene?
The beauties of COVID, the gift that kept on giving in 2020. So Viasat has their payload development. It's all internal now. They don't outsource, as opposed to like Hughes and all the other players and Geo. So all of that is done in Arizona, and Arizona had a stay-at-home shutdown order. So people, I know they were essential, but believe that they had enough COVID cases that it disrupted the workflow at the facility long enough. A. B. They still have a supply chain to deal with in space tech. And if you look at the Hughes calls, when they talk about Jupiter, they had the exact same issues. You just couldn't find components that you needed. Things were on back order. Just everything effectively shut down on the supply chain side, and lead times became excessive. So the 6-month slippage, which is unfortunate because honestly, the satellite should be right around the corner and not a year away. But the delay was a function of COVID, and a lot of their suppliers just not being able to do what they're supposed to be doing.
I think we'll cut it down there. Those were great questions. Thank you so much. Eugene, Eugene's an expert in this space, and we could probably go on for 2 or 3 hours on this. But if you have questions, please feel free to reach out to us. Look us up on covestreetcapital.com. We will also be posting this presentation to covestreetcapital.com so that you can see, so you run through it again. And we always want to hear feedback. We always like to hear the short side. So, if there's things that we didn't cover or risks that we didn't, that we paid short thrift, we're always looking for disconfirming information. So please, give us feedback, and love to hear people's thoughts. And Graham, thanks again for having us and sitting through, a longer presentation with us.
Definitely. Well, it's been an absolute pleasure, guys. We all, myself, Guru Focus, the audience, we're all very appreciative of the great wealth of knowledge that you guys provided with us today. And we really do thank you for sitting down and taking the time to walk us through that great presentation and answer some of those questions. It's been an absolute pleasure for us here. As Ben mentioned, there will be a full recording made available of this presentation. So if you want to tune back in, take a look back at any of those slides, anything like that, you can find it here. We're providing it to them for their website. You can also find it on with us over at gurufocus.com. Outside of that, once again, thank you guys for joining us today. And for everybody out there in the audience, and yourselves included, we do hope everybody can stay safe and stay healthy out there moving into the future.
Thank you.
Thank you.